And we're back with Investment 360. Lindsay and Mark are still with me to wrap up the top funds and investment insights in South Africa and beyond. Remember to join the conversation on Twitter at CNBC Africa, #Investment360. Research shows bullish global equities, but there's a growing skepticism because of politics and dubious monetary policy. Max King, strategist from Investec, joins us from London. And Max is on the line. Lindsay.
Yeah, Max, over the years you and I have spoken, and you've been absolutely right in everything that you and your team at Investec Asset Management are almost always right. But you come up with some fantastic fundamentals as to why we should be exposed to equities. You've had some really good calls on bonds as well. But I'm just getting the sense now, Max, that even a fundamentalist like yourself must be looking at the market and saying it's getting a little bit choppy, it's looking a little bit toppish, and there's some nervousness around. So I went to a few of those perma-bear websites that you and I have spoken about in the past, and you've laughed at me about them. But they're coming out with all sorts of things, and we sent you the graphs this afternoon. Non-confirmations, in other words, the S&P 500 going up but the RSI going down, the 52-week high chart going down, the S&P 500 going up. You've seen the evidence that I've presented. Does it do anything to change your fundamental view about bullish equities?
No, but you have to remember that the perma-bears, the end of the world doomsters, I mean, they've been wrong for nearly 5 years now, and they're getting pretty desperate. So they're coming up with ever more convoluted charts to try and explain why at last their predictions, which were basically a fall in the S&P 500 index for about 2/3 or more from here, might at last be right. I think that all these charts don't really add up to the real fundamental story, which is that global valuations are okay, earnings growth is expanding steadily, the global economy is picking up, and funds are flowing into equities, and that means that quite simply there are more buyers than sellers, and I don't think that's likely to change.
Max, it's quite interesting. My sense is that I would be rather exposed to a number of quality corporates, be it the equity or their bonds, than a number of governments out there. And I particularly think that the line of sight insofar as equity is concerned is probably more reliable than for the fiscal situation that we're seeing in a number of Western areas at the moment, and that includes sort of Japan too. Your take on that, Max?
Well, I think we have to be a little bit careful about the politics. So we have to remember the real reason why there's political friction, particularly in the US, but also in the Eurozone, is that governments and their populations, their voters, are at last realizing that ever-mounting debt and borrowings are not sustainable. And that's why we're getting such big kickback. So although I would agree that government bond yields in developed markets are currently too low, and we think they'll rise further in the rest of this year and next year, we're not permanently bearish. There will come a time when we will be ready to buy government bonds for reasonable, low-risk, long-term returns. I don't think it's going to be next year or perhaps late next year, but it should certainly be on a sort of on a 2-year timescale. I think it's quite likely. So I sort of think there's sort of light at the end of the tunnel in terms of bonds. We can see where we're going, and and we're not permanently negative on them, even though for now we prefer equities.
You're both hijacking my perma-bear technical analysis play here, but we had the Smart Money Flow Index, which we sent you as well, Max, which shows that a lot of people are buying in the first 30 minutes of the opening of the US markets, and that apparently can be indexed and played against the market performance, and every single time that it's been where it is at the moment, there's been a sharp sell-off. The other thing that is more interesting to me is the comparison of the graphs today to the build-up to the crash of 1987. Of course, here we are on October the 2nd, only 17 days away from the October the 19th anniversary. Do you think history might repeat itself, or is this absolute rubbish in your eyes?
Well, there's sort of 2 points. Firstly, on the so-called smart money index, what we've seen this year is money flowing into equity markets rather than out of equity markets. And when we get fund inflows, which often come in overnight, we put the orders on, as we are required to do, in the morning. So we know that what I think this sort of so-called smart money index is really indicating is that you're getting long-term investors who are buying earlier in the day. And of course, the phrase smart money index is coined by the sort of day traders and short-term traders who tend to think they're smarter than the rest of the markets. And personally, I think our very firm view is that long-term investors have a long-term record of being a lot smarter than the short-term traders. So I think that actually you could rename that almost the stupid money index rather than the smart money index. The smart money, like Warren Buffett, buys for the long term and holds without trading around. In terms of the 1987 parallel, well, I was around in 1987, and there's no doubt that after about 5 strong years in equity markets, at least 5 years in equity markets, the markets took off and were up 30% in the first 9 months of 1987. They got significantly overvalued. They came bumping back down to earth, and then you had another 5 years of uptrend. I just don't see any comparison with the current markets whatsoever, I'm afraid.
Max, I'm going to steal the conversation for a moment, and I know the market is ignoring this US partial federal government shutdown, but can I get your thoughts on what's happening stateside?
Well, I think it's easy as a foreigner to think that actually this is a dysfunctional US political system, but there's a very serious issue, and that is that, yes, the US budget deficit is coming down and the debt is becoming more affordable, but I think the Americans, and a large section of the American political establishment, and probably the voters as well, are saying, we don't want to be here. We don't want to be in the position whereby government debt escalates year after year and taxes have to go up to pay for it. They want to see a long-term solution, and that and they might get it. And I don't think it's quite as idiotic when you look at it from a US domestic perspective as it looks internationally. And the end result might actually be quite favourable, whereby we can look forward for not just the next few years, but for 10, 20 years, and start seeing the US debt relative to GDP coming down from the levels not that far short of 100% to below 50%, and that would be a very good outcome.
It seems as though there's a fiscal, a sort of consolidation theme, Max, that's coming through here on both sides of the Atlantic. And possibly indeed, although that might be implying a short-term squeeze, it seems that it could be reinforcing the economic fundamentals of many Western countries, and therefore that would be good for your equity call.
Yes, certainly. It is also visible in the UK and in much of Europe, and quite probably in Japan and in emerging markets as well. It does mean that within global economic growth, the government sector is going to be restrained for some time, leaving more room for the private sector to expand. That promises steady growth in the areas that matter for investors, whilst inflation is controlled by a government holding back. So yes, it's a pretty good environment for investors in the long term, which is one of the reasons why I think it'll be sensible to keep invested in markets for the foreseeable future. I'm not saying there won't be setbacks, a bit of volatility, maybe even the occasional bear market, but I think somebody who puts their money in risk assets, primarily into equities, and forgets about it for the next 5 years will be pretty happy when they wake up from their long sleep.
Max, the S&P about 2 hours ago was down 14 points. It's now only down around about 1.5, 2 points. I think one of the reasons is a report in the FT now saying that Obama has invited lawmakers to a White House meeting on Wednesday as a government shutdown, etc., etc. So they're getting around the table, and even John Boehner, who's a notoriously curmudgeonly and quite vicious-looking creature, he seems to be applauding this as well. Maybe more important is the ADP number that came out today, that private sector jobs report, which only showed 166,000 jobs were created, and the implications for tapering. You're a bull. Do you say to yourself, well, 166,000 jobs mean there's going to be no tapering, so I'll stay long on the market? Or are you a bear to say that this means the US economy is not firing on all cylinders with the obvious implications for earnings in the future?
Well, I think that what's happened in the US is that all the postponement of tapering has really just destroyed any sort of idea of forward guidance of monetary policy. The US economy is clearly picking up. We need a program which leads to the end of monetary easing. First, the tapering of quantitative easing, then the end of quantitative easing, then the rising of interest rates. And the sort of tearing up of that script has been very negative for the US dollar. It appears to be quite good for the US equity markets and even US bonds, but we have to remember that it only appears to be good because the dollar has weakened quite sharply in the last month. I think relative to sterling it was down something like 5% in September alone. And you know that devaluing your way into full employment is a policy which hasn't worked in the past, and I think it's quite a dangerous policy. So the sooner the US Federal Reserve turns around and starts easing back on the quantitative easing, I think the better. And certainly we'd like to see it, and that would probably reinforce our view that the dollar is probably worth buying at these levels.